Welcome back to the Everything Financial Radio Show on the Legacy Radio Network. We are chatting with Dr. Marc Faber. And in the last segment, Dr. Faber, we were talking about currencies, and then I asked a follow-up question about China. There are those that speculate that the Chinese currency, the renminbi, will ultimately be the currency that brings the rest of the world back in line by tying it to gold or a gold standard. What's your take when you hear such speculation?
I don't think that this will happen anytime soon, and basically based on the experience of the euro, the Asian countries will be very reluctant to kind of form a currency bloc. And we also have political disunity in Asia in the sense that we have rising tensions in the South China Sea between, on the one hand, the Philippines and Vietnam, and the U.S., and on the other hand, China, that wants to have more territorial rights, which from their perspective I fully understand. So a currency union is out of the question, and I think the Chinese will wish to have the flexibility that if their economy really slows down meaningfully, they can make an adjustment downward with their currency, because their currency has been relatively strong. So if they adjust the currency downward, they may regain temporary some pricing power and some competitiveness.
Dr. Faber, China and Brazil recently reached an agreement to trade in each other's currencies, seemingly bypassing the U.S. dollar. It seems that China may be positioning its currency to be the next world reserve currency, and certainly the dollar is being used less and less. What's your take on the U.S. dollar and its world reserve currency status, and if you would, speculate on not only outcome but timing?
Well, I have no doubt that the prestige of the U.S. dollar and of the United States, and also the relative importance of the U.S. within the global economy, is basically declining. It doesn't mean that the U.S. is sinking to the bottom of the ocean, but if you look, say, at the share of world GDP 40 years ago and today, then you can see that, say, China and India are growing as a percent of the global economy, the way all emerging economies are growing as a percent of the global economy, simply because they're growing at the faster level, at a faster pace, and from a lower level. And I think this pattern will continue. But clearly, whenever you have a superpower, such as the U.S. today, that is being challenged by new economic powers, the case was, say, Britain until 1910. 1910, the German economy became larger than the British economy, and then World War I followed. And so these shifts in the balance of economic power, they lead to huge tensions geopolitically.
Given the state of the United States fiscal condition, how would you explain the huge rally in U.S. government bonds over the last year?
Well, as I explained, a lot of people, they hold cash. If you are the treasurer of IBM, do you want to hold billions of dollars in cash with the banks, who you can't really trust, or you rather buy treasuries? With the treasuries, you may lose on the currency, and you may lose on the value of the treasury if they go down in value because interest rates go up. But because the Fed has basically backstopped treasuries, in other words, they say that they're going to buy treasuries and so forth, the risk of interest rates going up substantially in the immediate future is not very high. I don't think that bonds, treasuries, are as riskless as the market perceives it to be. but the other people, the other investors, perceive them to be riskless, and so they put cash in treasury, in bills, notes, and bonds. But part of the decline in yields has to do with the Federal Reserve buying. Over the last 12 months, the Fed has basically bought 90% of the issuance of the Treasury bonds and notes.
You know, on that point, Dr. Faber, the world central bankers are on a money printing binge. In your opinion,
they're out of their minds.
Yeah, when does this stop? I mean, you can't print money forever. What's the outcome, and what makes them stop?
Well, the outcome are symptoms of inflation. But we have to understand the concept of inflation is not necessarily the price of a mobile phone going up. It can be the price of paintings going up. It can be the price of fine wines or equities or commodities, or it can fuel inflation in China because we live in a global economy. So there are leakages between economies. You can print money in the U.S. and somewhere else in the world it leads to inflation. And so the obnoxious way of inflation is that it shifts from one sector of the economy into another and from one asset class to another, which creates very high volatility in markets and presents a challenging environment for investors.
So, Dr. Faber, those that say that money printing will lead to inflation, and then there's those that say that the debt excesses will ultimately lead to a deflationary period like the 1930s. Both sides seem to have lucid arguments, smart people on both sides of that argument. Where do you come down on this whole discussion between inflation and deflation?
Well, I think we can have both. In other words, we could have first deflation and then a bout of inflation, or we would have first inflation and then a bout of deflation. I would imagine that ultimately we'll have a complete breakdown of the financial system and the catastrophe, and that at that stage we'll have deflation. In other words, that prices of pretty much everything will collapse. But as an investor, say, if you have a bull market in asset prices, and the bull market in asset prices lift all assets, say stocks are going up 100%, and you only make 70%, then you're lagging behind, let's say, the 100% increase in the index. And when everything collapses, say, by 70%, and you only go down by 50%, then you're relatively better off by 20% compared to other people. And so I believe investors should always consider the possibility that the kind of Robert Prechter scenario where everything collapses eventually happens, and that commodities go down, equities go down, bonds collapse because they can't pay the interest, and home prices go lower and so forth. Then you ask yourself, well, in what asset I am best protected against losing everything? Now, I happen to believe that home prices in the south of the U.S., in Georgia, in Arizona, in Nevada, in Florida, are relatively inexpensive on a global scale. And yes, they can drop another 10-20%. But if that happens, I think other things may drop much more. Plus, if you own your home and you paid for it for cash, it's difficult for someone to take it away from you. Of course, if you borrow 90%, that is then your problem because you're over-leveraged. It's like buying the S&P and borrow 90%. If it drops 20%, you're out. You understand? You lost your money. So basically, I recommend the diversification and to look for assets that have already declined a lot. Like in my introduction, I said to you, some European stocks are very cheap because they're now even lower than at the March lows 2009.
So, Dr. Faber, we have about a minute and a half left. Quickly give us your prediction over the next 12 to 24 months for both equity markets worldwide and gold.
Well, I suppose that equity markets will be lower sometimes in the next 12 months and that you will have better buying opportunities than today. But they could also first go up and then down, or first they go down and then they rally and so forth. You see, as a market observer, to predict the markets is to start with very difficult. We don't know about the future. But if you have continuous government intervention, it's actually impossible to predict anything. And so I am reluctant to make very serious commitments, either long or short. I stay diversified. I have some cash and some bonds and some equities and some real estate and some gold.
And Dr. Faber, if someone wants to learn more about your work, if they're just joining us on today's show, could you give the website one more time, please?
bloomboomdoom.com.
Dr. Marc Faber, thank you for joining us today. We appreciate your time.
Thank you very much.
We will return after these words.